On June 13, 1998, the Sunbeam Corporation Board convened in a hastily called session at the company's Delray Beach, Florida headquarters. Within hours, the board terminated Albert J. Dunlap, the chief executive it had recruited 18 months earlier and whose restructuring program it had publicly endorsed in 2 consecutive annual reports. The immediate trigger, according to contemporaneous press accounts and the subsequent SEC complaint, was a Payne-Weber research note from analyst Andrew Shaw observing that Sunbeam appeared to be shipping outdoor grills in quantities that exceeded any plausible level of retailer demand for the season. The structural question this episode addresses is how a company selling barbecue grills, blenders, and electric blankets generated, for a period of roughly 18 months, financial statements that satisfied auditors, persuaded analysts, and supported a stock price that nearly tripled when the underlying sales were, in substantial part, not sales at all. The mechanism at the center of the Sunbeam fraud was a sales recognition practice known as a bill and hold transaction. Under United States generally accepted accounting principles, and specifically under the SEC's guidance, later codified in Staff Accounting Bulletin 101, but already well established through prior staff positions and AICPA literature in 1997, a bill and hold sale is one in which the seller invoices the buyer and recognizes revenue, but physical delivery of the goods is deferred. The merchandise remains in the seller's warehouse or in a third-party warehouse paid for by the seller until the buyer requests shipment. Bill and hold treatment is not by itself improper. It exists to accommodate legitimate commercial situations. A buyer may have insufficient warehouse space during a particular period. A buyer may have purchased seasonal inventory in advance and require staged delivery. A buyer may operate a just-in-time logistics system that depends on the seller holding finished goods. In each case, the economic substance of a completed sale is present, even though the physical transfer has not occurred. To recognize revenue on a bill and hold basis, however, the seller must satisfy a series of conditions that the SEC and the accounting profession had articulated with considerable specificity. The conditions, as the Commission summarized them in its 2001 enforcement complaint against Sunbeam, included the following. The risks of ownership must have passed to the buyer. The buyer must have made a fixed commitment to purchase the goods, preferably in writing. The buyer, not the seller, must have requested the bill and hold arrangement, and the buyer must have a substantial business purpose for that request. There must be a fixed schedule for delivery, reasonable in light of the buyer's business purpose. The seller must not have retained any specific performance obligations such that the earnings process is incomplete. The goods must be segregated from the seller's other inventory and may not be used to fill other orders, and the product must be complete and ready for shipment. These conditions are conjunctive. Everyone must be satisfied. If any single condition fails, the transaction does not qualify for revenue recognition, and the goods remain inventory on the seller's balance sheet until actual delivery occurs. The legitimate purpose of the bill and hold structure is to permit revenue recognition when the economic event of sale has, in substance, occurred, even though the physical event of delivery has not. The distortion arises when the form of bill and hold is used to recognize revenue in the absence of the underlying economic event. That is the distinction the Sunbeam matter turned on. The record shows that beginning in the second quarter of 1997 and accelerating through the fourth quarter of that year and into the first quarter of 1998, Sunbeam recognized as bill and hold sales a substantial volume of transactions in which the buyer had not made a fixed commitment, had not requested the arrangement, had no business purpose for accepting delivery on the seller's schedule, and in many cases retained an unconditional right to return the merchandise. A second mechanism operated alongside the bill and hold program. Channel stuffing, as the practice is colloquially termed, refers to the acceleration of shipments to distributors and retailers in excess of their actual demand, typically through price discounts, extended payment terms, or generous return rights that effectively guarantee the buyer against loss. Channel stuffing, like bill and hold, is not categorically improper. A seller may legitimately offer end-of-quarter incentives to move inventory. The distortion arises when the incentives are sufficient to ensure that the goods will be returned in a subsequent period, or when the right of return is so broad that the risks of ownership have not, in substance, transferred. The Sunbeam record establishes both mechanisms operating in tandem. Bill and hold transactions held merchandise in third-party warehouses, while revenue was booked. Channel stuffing transactions pushed merchandise to physical retailer locations on terms that all but guaranteed return. Together, the two mechanisms generated reported revenue that exceeded actual end customer demand by a margin the SEC's later restatement quantified with precision. To understand how the architecture functioned, it is necessary to begin with the operational context. Albert Dunlap was appointed Chairman and Chief Executive Officer of Sunbeam in July 1996. His prior tenure at Scott Paper and his published book describing his management methodology had established a public reputation for rapid restructuring through workforce reduction and asset divestiture. The Sunbeam board's appointment of Dunlap was followed within weeks by a stock price increase of approximately 50% on the announcement effect alone. In November 1996, Dunlap announced a restructuring program that, according to the SEC complaint subsequently filed, included the elimination of approximately half of Sunbeam's workforce, the closure or sale of a majority of its manufacturing and warehousing facilities, and the discontinuation of approximately 87% of its product stock-keeping units. The restructuring was accompanied by a charge against fourth quarter 1996 earnings of approximately $337 million. The SEC's enforcement complaint, filed in May 2001, alleged, and the consent orders subsequently entered established, that this restructuring charge was materially overstated. Specifically, the complaint alleged that Sunbeam established excessive reserves, accelerated expenses into the 1996 charge that properly belonged to future periods, and improperly classified ordinary operating costs as restructuring items. The structural effect of an inflated restructuring charge is twofold. First, the charge depresses the earnings of the period in which it is taken, which in this case was a period for which expectations had already been lowered by the change in management and the announcement of restructuring. Second, and more significantly, the reserves created by the charge become available in subsequent periods to absorb costs that would otherwise reduce earnings. The structure is sometimes referred to as a cookie jar reserve. The 1996 charge, in effect, pre-positioned a reservoir of accounting cushion that could be drawn down in 1997 to flatter the operating results of the turnaround. The SEC complaint identified specific reserves established in the 1996 charge that were subsequently reversed into income in 1997 without an underlying change in the facts that had justified their creation. These reversals contributed to the reported earnings improvement that became the central narrative of the Sunbeam turnaround story. The reserve mechanism was the first component of the architecture. The second was the acceleration of revenue. Beginning in the first quarter of 1997, the record shows Sunbeam began an aggressive program of trade loading, sales acceleration, and bill and hold transactions designed to pull future revenue into current periods. The SEC complaint described the bill and hold program in detail. Step 1. Sunbeam offered retailers and distributors substantial discounts on seasonal merchandise, particularly outdoor grills and other warm weather products, in periods well in advance of the season in which those products would normally be sold to end consumers. Step 2. To induce retailers to accept these early purchases, Sunbeam offered to hold the merchandise in third-party warehouses at Sunbeam's expense until the retailer requested delivery. The retailer was not required to take physical possession, was not required to pay until standard payment terms came due after eventual delivery, and in many cases was given the right to return any unsold merchandise. Step 3. Sunbeam invoiced the retailer at the time the merchandise was segregated in the warehouse and recognized the full sale price as revenue in that period, notwithstanding that several of the conditions required for bill and hold revenue recognition were not satisfied. The buyer had not requested the arrangement. The buyer had no business purpose for the early purchase other than the discount offered. The risks of ownership had not in substance passed, given the broad return rights. And the seller, Sunbeam, was bearing the storage cost and retained effective control over the timing of delivery. The SEC complaint quantified the impact. In the fourth quarter of 1997 alone, the complaint alleged that bill and hold sales of approximately $35 million were recognized improperly, accounting for a substantial portion of the quarter's reported earnings growth. For the full year 1997, the complaint identified bill and hold and other improperly accelerated revenue transactions accounting for at least $60 million of reported sales. The third component of the architecture was the use of guaranteed sales and contingent sales structures with major customers. The SEC complaint described transactions in which Sunbeam shipped merchandise to a buyer with an unconditional right of return, side agreements not reflected in the formal sales documentation, and in at least one identified case, an arrangement under which the buyer was effectively acting as a consignee rather than a purchaser. The complaint alleged that these transactions did not satisfy the criteria for revenue recognition under any framework, bill and hold or otherwise, because the risks and rewards of ownership had never transferred. The fourth component involved the timing of sales recognition more generally. The complaint alleged that Sunbeam accelerated the recognition of sales by, among other practices, recording revenue for shipments that had not yet left the warehouse, recording revenue on invoices that had not yet been issued, and in some instances recording revenue on transactions that the customer had not yet agreed to. The complaint cited specific instances in which sales were booked at quarter end against customers who subsequently confirmed they had placed no such order. Taken together, The four components produced a financial statement architecture in which reported revenue and reported earnings systematically overstated the underlying economic performance of the business. For the 18-month period from the beginning of 1997 through the first quarter of 1998, the SEC's later restatement reduced previously reported income by amounts that, for certain quarters, exceeded the entirety of reported earnings. In other words, for several reporting periods, the restated results converted reported profits into losses. The reported numbers supported a stock price that rose from approximately $12 at the time of Dunlap's appointment to a peak of approximately $53 in March 1998. The market capitalization gain over that period was on the order of $4 billion. During the same period, Dunlap caused Sunbeam to pursue and complete the acquisitions of Coleman Company, First Alert, and Signature brands, transactions whose financing depended in substantial part on the elevated value of Sunbeam stock used as acquisition currency. The detection failure in the Sunbeam matter is structurally instructive because the warning signs were present in the public filings and were observable, in principle, to any analyst willing to perform the relevant calculations. The question is why those calculations were not performed, or why the conclusions they supported were not acted upon, until June 1998. The first verification layer was the external auditor. Sunbeam's auditor during the relevant period was Arthur Andersen, and the engagement partner subsequently became the subject of an SEC administrative proceeding. The Commission's order in that proceeding, entered in 2002, found that the engagement partner had identified a number of the questionable accounting practices contemporaneously, but had concluded that the cumulative effect was not material to the financial statements taken as a whole. The order found that this conclusion was unsupportable given the magnitude of the items identified, several of which individually exceeded reasonable materiality thresholds for the company. The structural question is how the materiality judgment was reached. The record shows that Andersen's working papers identified specific bill and hold transactions, specific reserve reversals, and specific revenue acceleration items, and that the audit team computed the income statement effect of these items. The audit team's conclusion, recorded in the working papers, was that the items netted to an amount below the partner's materiality threshold. The SEC's administrative order found that this netting was inappropriate because it offset items of different character against one another and because it did not adequately consider the qualitative materiality of practices that, regardless of dollar amount, indicated a deliberate manipulation of reported earnings. The second verification layer was the analyst community. Sunbeam was covered by approximately a dozen sell-side analysts during 1997 and early 1998. The consensus rating was favorable. Several analysts published reports describing the Dunlap restructuring as an exemplary turnaround. The structural failure in analyst coverage was not primarily a failure to obtain information. The bill and hold practice was disclosed in general terms in Sunbeam's filings. The 1997 annual report on Form 10-K, filed in March 1998, included a disclosure that the company had recognized a portion of its fourth quarter sales on a bill and hold basis. The disclosure was brief and did not quantify the practice with precision, but it was present. The failure was in the interpretation of that disclosure in light of the company's reported earnings trajectory. A bill and hold disclosure in the financial statements of a seasonal consumer products company should have prompted an inquiry into the legitimate business purpose of the arrangements. the identity of the buyers, the terms of return, and the proportion of total sales represented. The record shows that one analyst, Andrew Shaw at Payne Webber, did pursue these inquiries and reached the conclusion that the practices were not consistent with sustainable revenue. The Shaw note of April 3, 1998, and his subsequent downgrade were the proximate cause of the unravelling. The third verification layer was the Audit Committee and the Board of Directors. The Sunbeam Board, during the relevant period, included individuals with substantial business experience. The Audit Committee received reports from Arthur Anderson and from management regarding the company's accounting practices. The record does not establish that the Audit Committee was provided with the specific magnitude of bill and hold and channel stuffing transactions, nor that it independently inquired into the matters that the auditor had identified internally as questionable. The structural observation, supported by the SEC's later enforcement findings against the audit partner, is that the verification chain assumed that each subsequent layer would catch what the prior layer had missed, while in practice, each layer placed substantial reliance on the prior layer's work. The auditor's materiality judgment was not independently tested by the Audit Committee. The Audit Committee's review was not independently tested by the analyst community, which relied on audited financial statements as a baseline. The analyst community's coverage was not independently tested by retail investors, who relied on analyst consensus. For detection to have occurred earlier, one of three things would have had to be true. The auditor would have had to conclude that the qualitative character of the practices, rather than the quantitative net effect, rendered them material and required adjustment or qualification. The Audit Committee would have had to obtain, on its own initiative, a quantification of the bill and hold and reserve reversal items independent of the auditor's materiality conclusion. Or an analyst would have had to perform the inquiry that Shaw eventually performed, but at an earlier stage in the trajectory. The fourth verification factor was the structure of executive compensation. Dunlap's employment agreement, as disclosed in Sunbeam's proxy filings, included substantial equity compensation and performance-based bonuses tied to reported financial results. The structural effect of the compensation arrangement was that the individual who controlled the accounting choices had a direct financial interest in the maximization of reported earnings. This is not, in itself, improper. Performance-based compensation is widespread and serves legitimate purposes. The structural risk it creates, however, is that the verification chain must function effectively because the preparer's incentives are aligned with overstatement. When the verification chain weakened, as it did at the auditor materiality stage, the compensation incentive was unopposed by any countervailing structural check at the preparation stage. The unravelling began in March 1998 with a series of internal events that have been reconstructed through the SEC's enforcement record and the subsequent civil litigation. Sunbeam's first quarter 1998 results were trending materially below the prior year's quarter, notwithstanding that the prior year's quarter had been flattered by the bill and hold and revenue acceleration practices described above. The practice of pulling future revenue into current periods creates a structural problem in subsequent periods, in that the pulled forward revenue has already been recognized and is not available to support comparable performance in the period from which it was borrowed. The Sunbeam first quarter of 1998 was the period from which the most aggressive 1997 fourth quarter pulls had been borrowed. On April 3, 1998, Sunbeam issued a press release announcing that first quarter results would fall substantially short of analyst expectations. The release attributed the shortfall to weather conditions and to inventory levels at retailers. The stock declined approximately 25% on the announcement. On the same day, the Payne-Weber analyst Andrew Shaw downgraded Sunbeam to a sell rating. Shaw's note, which the SEC's enforcement records subsequently identified as a triggering event, observed that the inventory levels Sunbeam attributed to retailers were inconsistent with the company's reported sales trajectory, and that the bill and hold disclosure in the 1997 annual report indicated that a portion of the prior year's reported sales had not in fact been sold through to end customers. The note specifically identified outdoor grills as a category in which shipments to warehouses appeared to exceed plausible retailer demand. In the following weeks, the Sunbeam board began to receive information from sources within the company that the accounting practices described in the Shaw note were broader than the analyst had identified. The record shows that the board engaged outside counsel to conduct an internal review. The review, conducted in late May and early June 1998, identified the magnitude of the bill and hold program, the existence of side agreements with certain customers, and the existence of reserves from the 1996 restructuring charge that had been reversed into 1997 income without adequate documentation of changed circumstances. On June 13, 1998, the board met and terminated Dunlap, along with the chief financial officer. The termination was announced by press release on June 15th. On June 25, 1998, Sunbeam announced that it had retained Deloitte and Touche to review the company's financial statements for the periods affected by the practices identified in the internal review. The Deloitte review, conducted over the second half of 1998, resulted in a restatement of Sunbeam's financial statements for fiscal years 1996, 1997, and the first quarter of 1998. The restatement, filed with the SEC in October 1998, materially reduced previously reported revenue and earnings for the affected periods. The restatement reduced 1997 net income by an amount that exceeded 60% of the originally reported figure for that year. Portions of the 1996 restructuring charge were reclassified, and reserves that had been reversed into 1997 income were restored to the balance sheet or reallocated to the appropriate periods. The first quarter of 1998 was restated from a reported loss to a substantially larger loss. In May 2001, the SEC filed a civil enforcement action against Dunlap, the former chief financial officer, the former controller, the former vice president of consumer products, and the Arthur Andersen engagement partner. The complaint set forth in detail the bill and hold practices, the reserve manipulations, the channel stuffing, and the related disclosure failures. The defendants resolved the SEC action through consent orders. Dunlap, in September 2002, consented to an order permanently barring him from serving as an officer or director of a public company, and to the payment of a civil penalty of $500,000, without admitting or denying the SEC's allegations as is standard in such consent resolutions. The former chief financial officer consented to similar relief. The Arthur Andersen engagement partner consented to a separate administrative order. Sunbeam itself filed for Chapter 11 bankruptcy protection in February 2001, citing among other factors the debt burden incurred in the Coleman, First Alert, and Signature Brands acquisitions that had been completed during the period of inflated financial reporting. The acquisitions had been financed in part through Sunbeam stock issued at prices supported by the overstated earnings. When the financial statements were restated and the stock price collapsed, the debt taken on to fund the cash portions of those acquisitions remained on the balance sheet at face value, while the operating earnings available to service that debt had been revealed to be substantially less than the acquisition financing had assumed. The bankruptcy proceeding resulted in the reorganization of the company under new ownership, and the Sunbeam brand continued in operation under successor entities. The shareholders who had purchased Sunbeam stock during the period of inflated reporting received a partial recovery through a class action securities settlement, the terms of which were approved by the Federal District Court in the Southern District of Florida. The Sunbeam matter establishes several structural observations about the bill and hold mechanism and the conditions under which it can be deployed to overstate revenue. The first observation is that the conditions for bill and hold revenue recognition are conjunctive, and the failure of any single condition is sufficient to render the recognition improper. The Sunbeam transactions failed multiple conditions simultaneously. The structural lesson, reflected in subsequent SEC guidance and most directly in Staff Accounting Bulletin 101, issued in December 1999 and substantially informed by the Sunbeam and contemporaneous cases, is that bill and hold disclosures in financial statements require specific quantification and specific representation that each of the enumerated conditions has been satisfied. The general disclosure that Sunbeam included in its 1997 annual report would not satisfy the standard of disclosure subsequently required. The second observation is that the combination of an inflated restructuring reserve with subsequent revenue acceleration creates a particularly difficult detection problem, because the reserve mechanism flatters earnings through expense reversal, while the revenue mechanism flatters earnings through sales acceleration, and the two mechanisms can be operated in tandem to produce a smooth earnings trajectory that conceals the underlying volatility. The structural response, reflected in subsequent accounting standards including SFAS 146, issued in 2002, which substantially tightened the conditions for recognition of restructuring liabilities, was to constrain the discretion available in the establishment and reversal of restructuring reserves. The third observation concerns the role of auditor materiality judgment. The Sunbeam audit working papers, as later reviewed by the SEC, identified the questionable practices contemporaneously, but concluded that they were not material. The structural response, reflected in SEC Staff Accounting Bulletin 99, issued in August 1999 and addressing materiality assessment, was to clarify that quantitative netting of individually questionable items is not an appropriate substitute for qualitative materiality analysis, and that practices indicating intentional manipulation of reported earnings are material regardless of the dollar magnitude of any individual item. The fourth observation, which is structural rather than regulatory, is that the verification chain that supports the integrity of public company financial reporting depends on each layer performing an independent inquiry rather than relying on the prior layer. In the Sunbeam matter, the chain failed at the auditor stage and was not recovered at subsequent stages. The Sarbanes-Oxley Act of 2002, enacted in response to a series of accounting frauds of which Sunbeam was a prominent early example, restructured the chain by requiring management certification of financial statements, by creating the Public Company Accounting Oversight Board to inspect auditor working papers, and by strengthening audit committee independence and responsibility. These structural changes were responsive to the specific verification failures that the Sunbeam and contemporaneous cases had documented. The Sunbeam record stands as a forensic case study in the misuse of a legitimate accounting structure. The bill and hold transaction has commercial purposes and remains an available accounting treatment when properly applied. The mechanism is not the fraud. The fraud is the use of the mechanism in circumstances where the underlying economic event does not match the form. The detection problem is that the form is observable in the financial statements, while the underlying economic substance is not, and verification requires inquiry that the verifying parties did not, in this case, perform until the position had become unsustainable.